With these last two chapters, we're moving from capital budgeting, which can be applied at virtually every level in a corporation, to two topics more the concern of upper management: dividend policy and capital structure. This is Chapter 14, Part A. Our first topic is basically dividend policy, how firms distribute profits to shareholders. Free cash flow is funds available for distribution to shareholders and bondholders. In this chapter, we'll cover the ways in which management distributes funds to shareholders through dividends or stock repurchases. A firm's distribution policy has three components: the level of cash distribution, the percentage paid out; the form, cash or stock repurchases; the stability of the distribution pattern. The percentage of distributions as a percentage of net income has remained stable, but overall cash dividends have declined while stock repurchases have increased. Cash dividend payouts have become concentrated in a small number of mature firms. Legacy dividends. They've always paid a dividend. Younger startup firms retain any earnings to reinvest in the firm. When their income reaches the point that they can pay out funds, they typically use stock repurchases. This table shows the average dividend yield for various industries. Electric utilities is the clear winner in terms of dividend payout percentage and dividend yield. The question of what investors want in terms of dividends has been revisited time and again. The three overriding theories are shown on this slide, and we'll look at each in turn. Dividend irrelevance was demonstrated by Miller and Modigliani in 1961. Dividend preference, the bird in the hand theory, was promoted by Gordon 63 and Lintner 64. The tax effect is a more recent theory related to domestic tax policy. Dividend irrelevance suggests that investors are indifferent between dividends and capital gains, since they can obtain cash either way. Merton Miller and Franco Modigliani supported the irrelevance theory in their 1961 publication. As with most fundamental finance theory, M&M 61 is based on very strong and somewhat unrealistic underlying assumptions. If investors are indifferent to dividends versus capital gains, then a firm's dividend policy should have no effect on its stock price or its required return. The bird in the hand theory states that investors would consider current dividends less risky than future capital gains. In addition, high payouts reduce cash available to managers to squander, thus reducing agency costs. If this theory is correct, then investors would reward high payout companies with lower required returns. The tax effect theory is based on the idea that lower payouts equal higher capital gains. Since capital gains are currently taxed at a lower rate than ordinary income, they're more attractive to investors who can control when they report capital gains. If this theory holds, then investors would reward low payout firms with higher stock prices and lower required returns. Clearly, these are competing theories. It doesn't matter. High is better, low is better. So which is supported empirically? There is some support for the tax theory. Internationally, firms in countries with low tax rates on dividends tend to pay out larger dividends. In countries with high taxes on dividends, firms tend to repurchase stock more often than paying dividends. While not directly supporting the tax effect hypothesis, it does indicate the effect of tax policy on payouts. Over time, the U.S. has changed the tax rate on dividends several times. In 2005, dividends were taxed at the same lower rate as capital gains. That expired in 2010 and then extended to 2012. 2013, dividends and capital gains taxed at 20% for high-income investors. 2010 and 2012, lots of uncertainty about coming tax changes. Uncertainty drove firms to take action. Over $7 billion in additional dividends paid. 176 companies moved dividend payment dates for over $12 billion in dividends. Higher payouts and accelerated payments seem to occur more in firms with high inside ownership. This evidence doesn't directly support the tax effect hypothesis, but it does show that taxes affect payout policy. International research shows support for bird in the hand, especially in countries with poor investor protection. Basically, mixed results. Investors prefer to avoid taxes, so tax policies do affect dividend payout policies. Let's look at the so-called clientele effect. Intuitively, this makes sense. There are clienteles of investors, some of which want dividends, some do not. Investors in high tax brackets may not want dividends, preferring to control when they're taxed based on when they sell the stock. Low tax bracket or tax-exempt investors, in IRAs for example, may want high dividends. The point is, once a firm identifies its clientele, changing their payout policy is not wise. Investors want a consistent policy, whatever it is. The signaling hypothesis is based on asymmetric information theory. Remember, we discussed early on how insiders to a firm know more than outside investors, so outsiders watch what a firm says and does as signals of its true value. Dividends are part of that signaling of true value. Reducing a dividend is a negative signal. Eliminating one entirely is a huge negative. It basically signals that the firm doesn't have the cash to pay the dividend. Increasing dividends tends to be interpreted as a signal of higher expected earnings per share. The residual dividend model offers firms a way to set a basic dividend policy consistent with their capital budget policy. These two are not unrelated: higher payout, less retained earnings to reinvest. The residual model is based on finding how much in retained earnings is needed to fund the capital budget, then paying out any leftover funds to shareholders. This approach does minimize flotation cost and the cost of capital, but has some other shortcomings if applied absolutely. Recall that capital budgeting assumes and requires that all investments be financed at the same debt-to-equity ratio as the firm. This means that if a firm has a target equity ratio of 60%, then 60% of every capital budget must come from equity, net income and retained earnings. Thus, when net income is divided between retained earnings and dividends, this ratio must be applied, with the capital budget needs covered first. Whatever's left is paid out as dividends. Let's follow an example of applying the residual distribution approach to our mini-case company, IWT. Here's the given data on the slide. Capital budget, $112.5 million. Target capital structure, 20% debt, 80% equity, and they want to maintain that. Forecasted net income, $140 million. Number of shares, 100 million. This table demonstrates how the residual model will play out in terms of dividend per share at various levels of net income. Note the fluctuation in dividends per share using this policy, from 0 to 70 cents a share, not something investors are going to appreciate. In addition to swings in net income, fluctuations in good investment opportunities would also cause the dividend per share to vary widely year to year. Again, not a policy investors are going to like. The advantage of the residual model is that it minimizes flotation cost. The major problem is that it results in possibly wide-varying dividend payouts year to year and would not be attractive to any specific clientele. The residual model is, however, useful in setting a baseline or target policy, but should probably not be followed rigidly. As the last topic in this segment, let's look at the dividend payout procedure followed by a firm. Declaration date. Every dividend is voted on and officially declared by a firm's board of directors, including the amount per share and the holder of record date. The holder of record date is the date on which the stock transfer book closes and a list of current shareholders is prepared for payout. The ex-dividend date is 2 days before the holder of record date. On this date, the right to the dividend leaves the shares, meaning the dividend stays with the previous owner if the stock is sold after this. And the payment date is, of course, the date the dividend is actually paid to the holders of record. This ends Part A of Chapter 14. In Part B, we'll continue our discussion of distributions to shareholders with stock repurchases and stock splits.